Well, I'll give you the definition right here in a second, but I'll tell you what, one of my favorite definitions I've ever heard is a bull market is when prices are bull, as in bull, S-H blank blank. You know what I'm talking about. But the actual definition here, guys, a bull market means that an overall trend of increasing prices exists. So basically, that is a time period when prices are going up and people are, generally happy with their returns in the market. Now, saying that the market is bullish, that could be referring to the market overall, which would be all of the stocks, or you can say this about an individual stock or sector, which is just an area of business where you could say, okay, I am bullish. So for example, I could say I am bullish on Genius Brands. That's one of the stocks in my portfolio. And then I could say maybe I'm bullish on a particular industry. There's not really much of that I'm bullish on right now, to be fully transparent, but that is how you would use that particular lingo. Now, on the other hand, I'm sure you've heard of the other side of the fence here, which is the bear market. And a bear market is basically when there's an overall trend of decreasing prices. So that's a time when people are putting money into the market, and then maybe 6 months later, 7 months later, they've lost 20, 25, 30%, 40%. It's a time when the average individual entering that market is in fact losing money. Not to mention as well here, guys, in the same way that you can be bullish on a particular stock, you can also be bearish. And that would apply to stocks as well as different sectors or the entire market as a whole. So if, for example, you were looking at a particular stock and you said, I don't understand why the price is so high, I am going to be bearish on that stock. Now, there's two different ways that you could be bullish or bearish on a particular, asset. You could be bullish with just your dialogue or bearish just by talking about it. And that's something called your sentiment or feelings towards the stock. But then you can also put your money where your mouth is and either be bullish, which means that you're long a stock, or you're bearish, which would mean that you are short. So it's kind of the situation here where verbally you could be bullish or bearish, and then you can put your money where your mouth is and do a bullish or a bearish bet. Most investors, retail investors, stick to bullish bets because short selling is quite complicated, but obviously, as we've heard about in the financial market news lately, short selling is quite a popular activity among the larger investors. So moving on here, guys, another term that used to just confuse me wildly is securities. A security is a tradable financial asset. So here's examples of securities: stocks, bonds, CDs, which is a certificate of deposit, and options. So if you ever hear somebody saying, oh, okay, I'm trading securities, they're usually talking about stocks, but it's oftentimes one of those things listed here as well. And also, guys, not just to mention here as well, public sales of securities are regulated by the SEC, which is the Securities and Exchange Commission. The next one to cover here, guys, is exchange. Another word you hear about quite often, and oftentimes what they're talking about is a stock exchange. This is simply a market where securities are bought and sold. Similar to way back in the day where people would go to a market to, swap their beans for corn and different, goods that people had. It's just a market where there's an exchange of items. In this example here, it's going to be those securities that we just talked about. So examples of exchanges include the New York Stock Exchange, the NASDAQ, and the Hong Kong Stock Exchange. There's also different smaller exchanges out there where penny stocks trade. However, those are oftentimes viewed as less desirable markets. Moving on here, guys, now we'll talk more about the SEC, just because it's good to know who is out there, as the watchdog for our financial markets. The SEC, or the Securities and Exchange Commission, is an agency of the U.S. federal government. Now, this was founded after the Great Wall Street crash of 1929, and the primary purpose of the SEC is to enforce the law against market manipulation. Now, I'll tell you what, there's a good handful of people that would probably disagree with that definition there at the bottom in terms of what the SEC is actually doing, but I'm just coming at you guys with the definitions here of what they are in fact supposed to be doing on your behalf. Now, the next term we're going to come across here is a broker, and then there's something else called a brokerage. A lot of people still are just unaware of the fact that there is a difference between these two and what the difference is, so we're going to cover it. Well, first of all, starting with a broker, this is an individual or a firm that acts as an intermediary for investors and exchanges. So at the end of the day, if you want to go out there and trade stocks, you yourself can't go running into, the New York Stock Exchange office and buy shares yourself. You do have to go through a broker. They're basically your stock dealer. Now, an exchange accepts orders from members only, so a broker works on behalf of individual investors. So common examples today of brokers would be Robinhood, Webull, Fidelity, M1 Finance, etc., all names that I'm sure many of you have heard of. Next up, let's cover the term shares. Well, shares represent units of stock when you actually purchase a stock. So through the IPO process, companies decide to issue stock in order to raise capital. And I just did a full video talking about IPO investing. If you're curious about how that actually works, I'll throw a card up in the corner. So individual investors can purchase shares of a stock in exchange for fractional ownership of a company. So basically, shares are units of the stock. If you have 10 shares, you have 10 units of that company, and that ownership is proportional to however many units or shares of that company exist out there in the world. Next up, we have another term you'll come across called outstanding shares. And no, these are not the shares that have done a really good job at being units of a company. That's not quite the case here. This refers to all of the shares currently authorized by a company and held by investors. So what we were just talking about earlier, how your number of shares you own gives you proportional ownership based on the total number out there. Well, this outstanding shares figure is going to tell you how many shares, authorized shares of the company, are out there. And then another term that you'll come across in this neighborhood is float. And that refers to the number of shares actually available for trading, because a lot of shares are owned by insiders. So you can't always look at outstanding shares. You got to look at the float to see, okay, this is the actual pool of shares currently available for trading. Now, as mentioned earlier, talking about bull and bear markets, we talked about being long and short. That's where you actually say, hey, I believe this company is going to go up or down, and I'm putting my money where my mouth is, and I'm hoping to make a profit in the process. So long refers to a situation when an investor believes they will profit on a stock's increase, whereas short refers to a situation where an investor believes they will profit on a stock's decrease. So I'm sure we've heard about short sellers out there. Those are people who are betting against individual companies. They're looking to make money as that share price falls. So another term that you're going to hear oftentimes is something called blue chip stocks. And these are going to be shares of companies that are well established, possess a strong reputation, and generally pay dividends. Now, that's not always the case, and a perfect example being Amazon. A lot of people refer to that as a blue chip stock, but they do not, in fact, as of this video, pay a dividend. So right there, you have a couple of examples. That would be Nike, Apple, Amazon, and Walmart. They're large, durable, well-respected, and they tend to be viewed as a lower risk investment into the stock market. On the other hand, we also hear about penny stocks, which are from smaller companies typically, and a definition of a penny stock is actually any stock that trades under $5 per share. So if you ever hear someone talking about a penny stock and it's like $3.55 a share and you're confused because you're like, that's more than $1. Well, there you go. Now you know the answer. That's what that is right there, guys. So penny stocks typically do not trade on major exchanges, and they often end up on the over-the-counter markets. They're less regulated and just a less desirable place to be putting your money overall. And the reason being is because many of these large exchanges have listing requirements, one of them being that you have to maintain a price of $5 or more per share. So if a company has a low share price for a long period of time, they can risk something called delisting, which is where they get the boot from the exchange and they have to go to the OTC markets, which is just a crappier place to be. Not going to be nearly as many people participating and looking to buy shares over there. So the next piece of information here, guys, is called the ticker symbol or the stock symbol. This is a unique abbreviation that identifies a company listed on a particular exchange. So just for example here, guys, the company Apple is symbol AAPL. Netflix is going to be NFLX, and Facebook is ticker symbol FB. It's literally just an identifying marker, whereas in the past, if you were calling up your broker on the phone, you'd say, hello, I'd like to buy, 10 shares of APPL. Actually, it is AAPL. I believe that might be a typo there, but double check before you actually purchase. But irregardless, that would be the process. You call them up, you give them the symbol, and then that is how they would process that transaction for you. Moving on, this gets a little bit more complicated, but it is good to know, and it's called the bid versus the ask as well as the spread. So the bid is something related to the price, and this refers to the highest price a buyer will pay for a security. If you think about an auction, this is somebody bidding on that auction. The ask price refers to the lowest price a seller will accept for the security. So the person bidding is looking to buy, the person asking is looking to sell something that they already have in a marketplace via this exchange. The difference between these two prices is known as the spread, and the smaller the spread, the greater the liquidity of the given security. So basically, if there's a ton of people trading a particular asset, the spread might be half a cent, where someone's looking to sell for $1.70 and someone's looking to buy for $1.70 and half a cent. But in a thinly traded market, you could have a really wide spread because no one's really selling the asset, where someone's looking to bid $1.20, but the lowest ask is $1.80. The issue being, if you were to place an order, your order could be filled in any range there, meaning you don't know what price you're actually going to pay. The next term to know here is called margin or buying on margin, and this is simply when you have a loan from a broker in order to increase your buying power. Generally not a good idea, not something that I use myself. I do take advantage of portfolio line of credit, but I do not use it for buying additional assets in the markets. But just be aware that this does exist, and this is what it's called. Every brokerage out there has their own terms and agreements with as far as it goes to margin. For example, 2-to-1 margin would mean that you could invest double what you have in your account. So if you had 100 grand, they would loan you another 100,000 at a set interest rate to basically give you more exposure to those stocks or securities. Another term to be familiar with here, guys, is called a dividend, and this is simply distributions that are made by some companies to their investors. Now, it's important to note here that companies are not obligated to pay dividends, and they can stop paying them at any point in time. However, it's not often desirable for them to do that because a lot of these companies don't have too much going for them in terms of growth because they've already become so large. So issuing a dividend oftentimes is the main thing keeping people sticking around. So it's basically money being handed to you typically on a quarterly basis to reward you for owning the stock, and they're sharing a portion of their earnings. So there's a lot more information in this, guys, in my video on dividend investing for beginners. I'll throw that up in the corner if you guys want to check that out after. And then the dividend yield is the annual dividends per share divided by the current share price. That tells you at a specific point in time what percentage of your investment you would earn back in the form of dividends over the next year. Another key term to understand here, guys, is something called an index fund, and this is simply a portfolio of stocks or bonds. So basically, instead of going out there and picking individual stocks, many people choose to invest in a pre-made basket known as an index fund, and these typically feature low expenses and lower volatility due to the fact that you are diversified and investing in a passive manner. I also did another video recently talking about how to research an index fund or ETF. If you guys want to check that out, there's going to be a card up in the corner if you want to check it out at the end of this video. The next term to cover is something called earnings, or this is often called EPS, which is the earnings per share. This is calculated by taking profits divided by the outstanding shares, and profits is going to be where you have revenue that comes in minus expenses gives you the profit. EPS is taking all of those earnings and dividing it by the number of shares, telling you per shareholder, this is how much that company earned. And positive or higher EPS typically is a sign of strength, as it denotes higher profitability, which can oftentimes lead to an increase in the share price. So EPS is a very important indicator that a lot of people follow when they are investing in stocks. The last term we're going to cover here, guys, is called the PE ratio, or the price to earnings ratio, which is one of the ways that people try to evaluate stocks in the market. Now, there's no end all be all out there, guys, in terms of one indicator that you can look at that's going to tell you everything about the markets, but the PE ratio is a decent indicator in your portfolio of tools. Basically, what it looks at is the ratio between the price or the share price relative to the earnings that company has, and it gives you an idea of if that company is expensive or cheap relative to their earnings. So typically speaking, a higher PE ratio could indicate that a price is a little bit expensive for a stock, and a lower PE could indicate that it is cheap. However, every industry out there or different segment of business has their own normal level for a PE ratio. That is why you can't simply just look at a PE ratio and say, oh, that's cheap, or oh, that's expensive. But it is a good indicator to know, and definitely one for further research. So anyways, guys, that is going to wrap up this video. I hope you enjoyed it. If you made it to the very end and you enjoy videos about investing, make sure you subscribe and hit that bell for future notifications. And as always, guys, I hope to see you in the next video.